let me open up the policy real quick. So
Yeah.
basically, when we talked earlier, we go over that thing and like the kind of like the base premium something it kind of low, so we want to maximize the POI whatever.
Yeah.
And when it's go under the application, it's like the base will double. So I don't know if
Mhm.
something changed, whatever.
Yeah, absolutely. I allowed you to share.
Yeah.
So
Okay.
if you want to share your screen, you're more than welcome. And
Okay. Yep. Pair mutual. Okay. So right here. So let me share screen. Let me see. Let me see. Share screen three. Okay. This is the one. You see my screen now?
I can, yep.
Okay. So let me see. Okay. Here we go. Oh, that's the one, right? Nope. There's some. Let me see. Let me start over. Let me see what's paid. Year five, something. Okay, this one. Okay, so this is what we got. So I mean, um, before when we play around with the number, this number was 7,500 something, right?
Correct. Yep.
Yeah, and this is higher. So I will go to have those number as high as possible, so can have the higher cash value, right?
Yep.
And this
You're
one,
exactly right.
yeah. So I know if something happened, something changed, whatever.
It did. I changed it.
Oh,
So do you see the total premium that's listed there?
yes, 18. Yes.
18,000.
Yep.
So that was kind of the number that I was starting with. And then typically what we'll do is we'll take 30% of that and put it towards the base premium,
Okay.
and then 70 going to PUA. And those are kind of the range that you and I were looking at.
Yeah.
When I submit an application, what I'll do is I'll actually put more money towards the base premium.
Mm-hmm.
The reason that I do that, do you see the death benefit over here on the right side?
On the right, that benefit. Okay. Okay. Yes.
Yep, it's 958, I think is what it is.
Yeah.
But for round numbers, let's just call it a million, okay?
So 958. Okay. Yep.
958, we'll round it off, we'll call it $1 million.
Yes. Okay.
I may have mentioned this before, but if I haven't, this is worth noting, is that the insurance companies really only care about death benefit.
Okay. Yep.
And so when I submit an application, they don't look at like premiums and PUAs. They're just looking at the death benefit amount, and that's what they're underwriting you for.
Okay.
And so when we were designing the policy, I think the death benefit on the policy that we're looking at was maybe 600, maybe 700 in there.
Yep.
And so what I did is on the application on that illustration right there is I put more money towards the base premium to kick up the amount that we're asking them to approve you for. And so
Okay.
if we ask them for a million, now we can design and get an approval at a million. We can design anything underneath that amount that we want.
So you mean that's it for the policy after? So that's it, the number we start, and then the policy we start later. That would be below that number.
Yeah, so again, the insurance company is only concerned about the death benefit amount. The policy that you and I looked at last time, the death benefit was about 600.
Yeah.
And so I'm asking them for just a little bit more than what we'll actually put into place
Hmm.
so that we can still design what we need to design. If anything changes, we still have some room to change it.
Okay. So
Yep.
so is there anything like sorry, anything and another hand we want to maximize the cash value. So do they look at the cash value as a factor?
They really don't, to be honest with you,
I
John.
don't. Okay.
They don't. But again, like, right, so you and I are going to be more concerned about the cash value piece to it.
Yeah. Yeah.
But again, the insurance company only cares about death benefit. So On
Yeah,
this application that we're submitting, I'm gonna put the death benefit just a little bit higher than what we actually will want or need.
yeah.
That way, here in the next week or so, we can change a design if we want to.
Oh, got you. I got you.
Yeah.
So now we
Yep.
put it to the ceiling, and when they're okay with that thing, then we still can change it, right?
Exactly.
I got
Yep.
you. So the goal at for now we get the limit and then we change. And when we change after, the goal is to have the high cash value later, right?
Exactly. Yep.
It makes sense. Does it not
Yep.
what we end up with? We don't want to get the high base premium. We want to have the maximize the cash value,
Yep.
right?
Yep. You got it. Exactly.
Okay, yeah, yeah. Okay, it makes sense now.
Yep.
Okay, yeah.
So practically, kind of what will happen
Hmm.
is when we sign for this application and we get it submitted, they're gonna underwrite you for $1 million. They're gonna say, "Yep, John, you're good. We'll approve you at this amount."
Yeah.
And then what we're gonna do is we're gonna come back and we're gonna say, "Hang on, Pan, we don't want to issue that one. Here's what we really want to issue."
Ah.
So, yep. So there'll be one extra step here. That way we've got some time.
Okay, then we change the base new and lower, right? To
Yeah, you
37
got it.
something like we had last time.
Yeah,
Okay. Yeah. So I mentioned earlier, so we will have some other policy later. For now, like 18, uh, like 18 a year. That's it. Nothing. It takes forever to buy the house. So
yeah,
the house that we bought last time, we down like 500. So, and yeah. But anyway, something to start, and then after we have some other thing that we can dump a lot more money on it. So
exactly. You
yeah,
got it. Okay, yeah.
yeah, yeah.
So we can. That's what we can do today. Is I can. We'll jump in there. I'll let you give you a little underwriting update in addition to this, and then
Yep.
if we look at some other designs, I'm happy to do that too.
Okay. Yeah, 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 yeah. So let's say, the plan that I have right now is to buy the house that I down like 500-600 a year every year. So if there's a way we can do that with the policy, like we had a policy that we can put that much money, or we have something around that,
How much money do you want to? Are you anticipating a year?
500.
500,
Yeah,
500,000.
yeah,
Okay. So that would be a bigger policy than what we're looking at here,
yeah.
right?
And then
So
every
t
year something, but not like 10 years.
so tell me about that. Maybe I don't. Where's the 500 going to come from? Is it coming from this new property?
So it's from my income, and some from
Okay.
my like from my work, my business, and also from the other property.
Okay.
Yeah.
So what? So you'd like to or look at designing a policy for that could handle about 500,000 a year.
Yes.
Okay.
Without stress to pay that $500 um, every year. So let's
What
say we had a
what's your
policy. I'm
yeah,
sorry, right?
what's your earned income right now? How much money are you bringing in annually?
Annually, yeah, by
Yeah.
the book, it's about 300 something, but actually it's more
Okay.
than that.
How much do you think it is off the book?
Yeah, off the book. So I would say six, seven.
Okay.
So let's say six. Yeah.
Okay. And what have you been doing with those dollars previously? Have you been putting it just into properties every time you acquire it? What?
Yeah, yeah, just put into the down payment.
Okay.
Yeah.
If we take and we design something with 500 going in, right? If that's our
Hmm.
income,
Yeah.
do you need any of that 500 for kind of living expenses, or is that strictly for investments?
Just for investment.
Okay. All right. I
Yeah.
just want to make sure because
Yeah.
I don't want
Yeah.
to get in a position where we've got money that's coming in that we're paying to a policy that we need to take out just to pay bills or some sort of bills,
Yeah,
right?
I agree.
Uh,
And another thing
ideally,
is, yeah, another thing is like we want something like we don't really have to like stressed on
Yeah.
prevent. So let's say the policy, let's say 200K, but I had the option to put 300 more on it if I want to, or if I can. But if I don't, I just put it's okay with only 200 or something like that.
Yeah, let's see here.
Yeah,
Let's do this. Well, let's do this, John.
yeah,
Let's kind of take this in order if that's all right.
yeah.
So, let's jump back over to your pen application.
I'm
And
sorry.
if you're let's jump back over to the pen application, the one that we have submitted.
Yes.
Let's wrap that one up and we'll get that one submitted to pen and then we can shift gears and kind of jump over to this option. How does that sound?
Yeah. Okay. Yep. So
Okay. All right.
I just log into that policy right now,
Perfect.
and oh, that's application preview. I don't know what else I should do. That's all I have over here.
Perfect.
So sign application, right?
Yep,
Okay. But I'm signed. That doesn't mean that I accept with the that base premium, right?
that's correct. So
Okay.
what you're signing right now, John,
Mm-hmm.
is we're submitting that illustration to pen and we're asking them to start underwriting on that $1 million ish.
Oh yes, and that one. Okay, not that specific. Whatever.
Yeah,
Okay. Okay. I do right now. Okay, done.
perfect. Here's one of the things I was going to share with you today was this
Yeah.
is that even before you kind of submitted that application,
Mm-hmm.
Penn gave us a tentative rate class for you. Do you see my screen here?
Not yet.
Okay.
Okay, let me see.
Let me know when it pops up.
Yeah. Zoom. Let me see. Oh, I opened too many window. What's that? And I try to see.
Any luck? I can stop and start again if it's not sharing.
Yeah, let me see. For some reason, it just show. Okay. Zoom. Hmm. Can we just hang up and start over real quick?
Yep.
Okay.
Yeah.
All
I'm just gonna stop sharing. Let's start with that.
right. Okay.
Oh, I think it's because you're still sharing.
Oh,
Let's do this.
probably.
All right, let's do.
Okay. Yep.
Got it? Okay, perfect.
Yep. Okay.
Great. On the screen, do you see here in green writing?
Great class. Okay.
Yeah. So, what Penn will do is when you fill out the life and health section
Mm-hmm.
of your application,
Yep.
is they're going to analyze it here pretty quickly. They're going to take all the information that they need. They're going to review it. If nothing jumps out at them, there's no concerns.
Mm-hmm.
Underwriting, you can fly right through, and they have already given you a tentative rate class
Okay. What's that?
of that means that once we sign this and get it submitted, which is what we just did. So you signed it, now it's going to get kicked over to me, and then I'm going to sign it and get it formally submitted.
Yeah.
You're gonna come back with a preferred plus rating here pretty quick.
Yeah.
So probably later today, right?
Oh,
Or this
really?
week. Yeah, you'll get an approval here real quickly.
Oh. Okay.
And so that's good, right? So
Yeah.
now we know that you are approved for $1 million of underwriting amount.
Yes.
And so now we can look at this original policy, and what we can do is we can change it to what we would like, kind of that 70-30 split.
Okay.
Okay. And so we can wrap this one up here pretty quickly if you'd like to.
Yeah.
So,
Yes.
so that way when they come back to us here over the weekend or even on Monday, and they say, great, you're officially approved at Preferred Plus for the $1 million, I'll have the illustration that we want to issue, and I can send it into them and say, hey, here's what we want. And so we just kind of keep it moving. How does that sound?
Yeah, yeah. So now we start with what we want, right?
Yep,
Okay.
exactly.
Yeah, we can
Perfect.
do that. So my goal is to maximize the cash value.
Yeah.
Yeah, maximize it.
Yep. So let's look at this one. The one I'm going to pull up right now.
Yeah, I don't need that benefit. I need anything for
Yeah.
my son.
How old's your son? Did I know it? Did
Four
I know
and
you
one.
have? He's one?
Yeah, one and four.
1 and 4. Okay.
Yes.
Okay.
Yeah.
Perfect. So here's the illustration that we looked at last time,
Yes.
right? So we were started with 18 and then we looked at kind of maxing that policy out.
Yes.
So in this example, right, we've got looks like about 5,000 going to the base premium.
Yep.
And then we've got, man, on the high end, you can put 16,000 into the PUAs here.
Okay.
Okay. So total premium in this one that you're going to get approved for, you could put just over 21,000 in annual premium into that policy.
Yep.
Yep. And here's the kind of cumulative numbers. And I think this is what you were referring to when we got on the call, right? Is looking at this,
Yeah.
not too exciting, right? Like it's a
Yeah.
good policy, but the numbers are a little low for us. Is that what I'm hearing?
Yeah. Yeah. Yeah.
Okay. Okay. All right. Perfect. Uh, John, do you feel like you got a good understanding of this policy right here with the base premium PUA and your flexibility there?
Yes, yes. So
Okay.
if that's something, yeah, you mentioned last time I playing with the number, but like if that's the maximum ratio that we can get for the cash value, or we can get higher.
Yep. This is going to be pretty dang close to it.
Yeah,
So the 16,950.
yeah.
Uh, when you see a number like that, that means that your mech line was probably 16,953.
Okay, so we don't want to hit that MAC, right? When you get that
Yep.
MAC, we have no tax benefit, right? Right.
Exactly. Yep. So usually I won't do an odd number. I'll just kind of back it down just to a round number there. So that's how we get to kind of this weird number
Okay.
here, 16,950.
Okay. So that means for now the net benefit is 504. So that means we can double that number, right? We can do
Yeah,
the policy for adding double, right?
exactly. Yeah. So you're going to get approved for $1 million. So you could essentially do two of these if you wanted to.
Yeah, just do one and double the number.
Yeah, right? Yep.
Yeah,
Yeah. Or we could do one policy and just double these numbers right here that
yeah,
we
it's
see.
easier. You don't have to do two. Yeah, they're more
All right.
working to
Yeah.
manage.
Yep.
So
Perfect.
what the benefit for two separate policy instead of one double one?
They're the they're more of it would be more of an intangible benefit.
Intangible?
Yeah. So not like dollars, right? Um, we've done a few podcasts on this, and we talked about this recently of, hey,
Hmm.
should I have one policy or should I have two policies?
Yeah,
If I were to run two illustrations pretty much identical, right?
yeah,
Same dollar amount.
yeah,
If we were to add up those cash values and put them together and just run one example, they would be identical.
yeah,
The benefit that comes into play, John, when we have kind of if we split them up and go with two policies,
yeah.
uh, is really on the premiums, right? So if we're paying a premium annually, we have the option of paying some now and then some later, right?
Okay.
Annually next year when that policy premium comes due is, hey, all of it's not due at one time.
Oh, okay. I got you. Yeah, we
Yeah,
spread out.
exactly. So there is a benefit,
Yeah.
right? But it's not a dollar amount that you can see. It's more intangible.
Okay, I got you. Yeah, yeah, I'm okay with the with one bigger policy.
Yeah, I was gonna say the way that I would suggest you look at this or decide between one or two
Hmm.
is if the base premium amount in this example 5,000, or if we double it 10. If 10,000 is not a concern for you of being able to pay that annually, then
Hmm.
I would just do one policy. I wouldn't mess with the two.
Yeah,
Yeah. So yeah. So is that kind of what you're thinking? Do you want to look at an illustration where we double this?
yeah, yeah. And I have a question. So
Sure.
let's say Penn they approve 4 million. So that means that's it combine all the policies together, the million, right?
Yep.
Okay, so let's say when I hit that number, let's say now I saw with that number, if I want another policy, I had to look around for another insurance.
Uh, so if let's go through kind of an example here.
Yeah,
If we go through and we put in this policy, right, it would
yeah,
be the $1 million, right? Double the
yeah,
premium.
yeah.
Uh, and if we wanted to put in an additional policy, we would need to go back and ask them for more underwriting amount. So
Oh,
we'd have
okay.
to hit application number two.
I got you. Yeah,
Yep. Yep.
yeah.
Perfect. Let's do. Did you see this here?
Yeah. What's
So
that?
it's telling us that out here in the 2020th year that we may run into some mech issues if we're max funding this policy for
Oh,
20
at the
years.
year 2020, 21.
Yeah, yep.
So kind of
Uh,
like we're no longer how to say get the tax benefit, right?
yeah, so there if this is something you'd want to put in place, what I would look at doing here would be there's a couple things I would say.
Yeah.
This illustration shows it being max funded every year for the next 20 years.
How's that? Can I say it again?
Yep. Yep, this example
Yeah.
shows it putting as much money into this policy as we can every year for 20 years. Do you see
So
how in year 21 it shows a mech?
so that means after the year 21, if we put more money, and then that will be max. So that means what we should do is when we get to the year 20, we stop doing that.
Yeah, exactly, right? So that means if you wanted to max fund this for 20 years and then stop, you could do that. But right in that 21-year mark would be our limitation where we need to drop back the funding on it.
Okay, so the year 21, we still can keep doing, but it have to be dropped, right?
Correct. Yep, yep.
Okay. Or what other option we have?
hmm
What other
I'm
option
gonna,
we have?
yep, I'm gonna do this all through
Yeah.
uh 15. What I just did here, John, is I just backed off
Oh,
some of the PU payments a little bit sooner,
yes.
right?
Okay.
So what I would tell you here is looking at this illustration and having it show a mech in year 21.
Yep. Disappear.
The likelihood of us max funding a policy every year for 20 years is probably pretty low,
Yeah.
right? There's going to be a year in there or maybe a couple here and there where, hey, maybe the premiums don't line up with our savings accounts, right?
Yeah.
So maybe there's a year where we don't pay the PUAs, right? Just because we've got money going to a different investment here, there, something like that. So
Yeah,
with that said, is my concern of a mech in year 21 with just a fully max funded policy. It's a concern, but it's pretty low on the priority scale.
yeah,
Along the way, we're probably not going to be max funding it to that extent. So
yeah.
what I did in this example is I just backed off on the funding, and you could even max fund it for 15 years and still not run into any mech issues here.
Okay.
Yep.
So this is more a little safer, right?
Yeah.
So
Yeah.
yeah. So we start to drop like 5 years early
Yep.
than the max, like at the year 21, right?
Yep. Yep.
Okay.
And this one looks obviously much better. We've got some bigger cash values here sooner.
Okay. So pretty much total cash value. Oh, so at the year five, right?
Yeah.
Pretty much.
Year 4, we're positive here.
Yeah, like year over
And
year, and at the
yep.
year six, the total will be
Yeah,
over, right?
in year 6, we're positive. We're really close in 5. We're a few
Yeah.
thousand off, but year 6, 263, 271.
Okay.
And then it just takes off on us.
Okay. All right. Year 10, I put 439 total. I get 323, 523.
Yep. And it's
Okay. Yeah.
increasing it almost
Yeah.
double. 43 is going in. We got 68 available.
Yeah.
43.73.
Yeah. So then the money that we put in the last 10 years will work for us, right?
Yeah.
Yeah. Okay. Just like planting a tree.
Yeah.
Yeah. So it take in the first couple of years we have to water whatever a lot and don't see any fruit, right?
That's exactly right.
Yeah. Okay. Got you. Okay.
Perfect. So is this probably something more that lines up with your goals here? Is this type of funding more than the previous one?
Yes.
Okay. So what I'll do is you just sign that illustration. So what we'll do is we know you're going to get a rating. I'll
Yep.
let I'll let Becky know that we want to back out that illustration,
Yep.
and then I'll have her update it. So you will probably have to sign one more time for us if that's all right.
Okay. Sure.
Okay. All right, cool. So we'll get that one updated.
Yeah.
Let's do this here. Let me make a note here before we jump over to the next one. John, any questions on this illustration that we've been looking at here?
Any drawback on that one? Anything I had to? I mean, anything I need to worry about?
Nothing that you would
Yeah.
need to worry about.
Yeah.
What I would highlight would be now your base premium on an annual basis
Mm-hmm.
has now increased, right? So now the
Okay.
have to portion is double what it was before. It was at 5 and now it's at 10.
Yeah.
So if 10 is an easy number for you to be able to put away each year,
No.
I think it's a great policy.
Yeah. Yeah. No problem.
Yep. Okay.
Yeah. Like
And then
for my income, I've been making. I don't know, it's good, and in the next year probably I'm trying to sell the business, so I will get like just the half of the income left just from the investment. but I'm okay to have less money and and have more time. Yeah,
Yeah.
yeah, but we still can make some. So we're good with 40,000 a year.
So is that kind of where the 500 is coming from, or is that kind of if you just keep doing what you're doing, you've got 500 to be able to put away?
So if I keep doing what I'm doing, I have more, like five, 600. But then stop doing that, so I get like 300. Yeah, so it's still way above 40, whatever. Yeah, I don't live the fancy life, so I don't really have any boat or yacht or whatever. So yeah, just normal lives. Yeah,
Man, I'll tell you what, keep it simple, and
yeah,
life is pretty nice that way, right?
yeah, right, right. Like we have anything that back in the old day we don't have. So I'm good with that. Yeah,
But
and
yeah,
yeah,
I understand that, right? My wife and I have been in our house for quite a while, and
yeah,
we could move if we wanted to.
yeah.
But man, we got a great house. There's no reason to move, and man,
It's
we got a great lifestyle, right? So
yeah, exactly right. Yeah. So I and my wife would talk about the we like we fall in love with small house like 13 square feet something. Like a
yeah,
small house, two, three bedroom. That's all we want. Right now, we live in a bigger house, like 2400 something. It's just normal bigger house.
yeah,
We have big family, but like when our kids they grow and they're not, we are just two of us, and we are good with that 1300 square feet house. We live simple life and we travel.
yeah. Same. That's what we do, right? Is
Yeah,
on the weekends if we've got an extra weekend, we're going somewhere,
yeah,
uh,
yeah,
hanging out, and so man, it's man, yeah, I completely agree with it, and it's a great place to be.
yeah. That's right. Like I feel like we had a big house and then we just tied into it and like we had to spend a lot more time to take care of the house. Or you don't, and then that doesn't look good and you don't feel good when you're home.
Yeah,
Yeah,
absolutely.
yeah,
Then you get burned with everything. Let's do
yes.
this. So John, you'd mentioned kind of putting away 500,000.
Yeah,
I'm gonna run an illustration here with pen.
yeah,
And that'll kind of be our starting point.
yeah, okay.
So what I'll say is one is if we start putting that amount of money away, what I would
Yeah.
tell you is a couple of things. One, my advice is we can start looking at what that would look like on a policy.
Hmm.
Number two is that if you start putting that amount of money away, we probably want to split some of that up amongst family, right? So maybe your wife and maybe your kids, we look at policies for them.
Oh, so we have few different policy for different people.
Exactly, yeah. And then additionally, too, is I would probably recommend that we split some of that up between insurance carriers.
Oh, yes.
So it's not just one company that we're sending that to. Let's split it up, and the companies will be similar, but they won't be the same, right? So they
Yeah.
operate differently. So we've got some, some prudent diligence being done, and diversify some of that a little bit.
Yes.
I've got my policies that I have with my family. I think we're spread out amongst three or four different insurance companies right now.
Yeah. Okay. Wow. And by the way, I had a question about my kid. They are like one
Yeah,
and four. So can I and should I have a policy for them?
the answer is yes to both.
Yes for both. Okay.
Yep. So you can have a policy on them. So anytime a child's 2 weeks or older, we can put a policy on them.
Yeah.
And then the second one is should we? This is an opinion question, but the answer is yes. You should have policies on your kids. I've got policies on my kids.
Okay.
Uh, so instead of doing 529s and those types of accounts, I put policies on them. And Man, it's a great way to save and still have access for it.
Yeah, it is a lot simpler, right? It's much
Very it
simpler than
Yeah, it's similar, simpler. We've actually got more options available to us when
yeah,
we use the policy than we do put money in a 529 plan.
yeah.
So
So
we've
the
got
question,
less risk with more options.
yeah, I got you. And the question is, can I have control over my kids' policy? Truthfully,
Absolutely.
yeah,
So great question. Let's talk about that for a second.
yeah.
So with my kids' policies, John, the way that I have it set up is I have it set up to where I'm the owner, I'm the beneficiary, and they're the insured.
Okay.
So I'm the one paying the premiums and creating the cash value. And so I have ownership over the cash value.
Mm,
Uh, and it'll stay that way until I change it.
okay. Yes.
Yep.
Okay.
And
No question.
that'll be at a later date down the
Yes.
road if I choose to do that.
Yes. Yes. Yeah. So we will do that
Yeah,
after. Yeah. Just whatever time.
great.
Yeah. Question about the trust.
Yep,
Yeah, I had a trust, and at the end of the day, like when the policy is done, I still can change the beneficiary to the trust, right?
correct.
Yeah.
Yes.
Okay.
Do you have a trust in place right now?
Yes.
Mm, great. Um, let's do this.
Yeah.
1 second. Let me look at our application. Do you have a trust certificate?
Certificate. I had the one that I like notarized with the bank. Yeah, that's the one.
Yeah.
Okay, you want that?
So on the trust, there should be kind of a one page right up front, and it'll say trust certificate. And it's a summary of what's in the trust of ownership and beneficiary and everything. And
Let me see. I'm not
if
sure. So that is like who give it that certificate?
say that again.
Who give us that certificate?
I'm sorry, John, I didn't catch that.
Yeah,
Say
I
that
mean,
again.
where we get that thing from? The only one I have that is we have the document whatever we bring to the bank. They notarize it, and that's it.
Okay. Um, on the trust, if you open it up,
Hmm.
just in the first couple of pages, there should be one that shows it's a summary and it'll say certificate of trust written right across the top on the first maybe 10 pages of the trust.
Uh, let me. Okay, let me see. So that's something like we have someone to do the trust, and then they send over that certificate, right?
So when they finalize the trust, that's one of the pages that they'll include in there.
Mm-hmm.
So that if you do open a checking account or savings account for the trust, you can
Yeah.
pull that page out and take it to the bank.
Oh, I don't have that.
Okay.
Let me just send you what I have.
Perfect. Perfect.
Yeah.
And if there's one that's not in there, we'll just send an email to your estate planning attorney. We can ask them to send you one. They can draft
Oh,
it.
okay, yeah. Let me see.
So this is good. I'm glad this came up because what I will do is if you've got a trust in place,
Yes.
then I'm going to have Becky kind of reset this application that you just signed, and I'm going to put the trust as the
That's
beneficiary of the one that we just looked at.
okay. Yes, yes. So we don't have
Great.
to change it later, right?
Correct. Yep. And then I'm going to copy and paste this link here.
Yes, I just send you the link to the trust.
See if I can get in there. Make
Yeah,
sure I can get perfect. Okay. So I can get in there.
yeah.
Great. Making a note for.
Yeah,
Okay. So we're definitely going to need at least one signature when we reset this because we are going to make a material change to that application. We're moving
yeah,
one beneficiary off and putting another one on. So
yeah,
um, there might be a couple things for you to fill out too.
yeah,
Okay.
yeah. Okay, yeah. Did yes? Whenever she text me, I will check the email. I don't check the email often, or
Okay.
almost never check email.
Okay. Thank you for letting me know that.
Yeah, but I'm glad that she text me anytime. Just make sure she text me. Yeah, I check the email whenever people ask me to.
That's the deal.
Too much email nowadays. There's a time I try to like clean up my email every day. And if you're like, oh,
Oh,
too much work, it's better to just don't look that up.
right.
Yeah.
I am I'm not very good at that. In fact, so I delegated that to Becky.
Good. Yeah.
So Becky filters emails. She puts them in action and then an FYI folder. So if it's important, I look at it. If it's not, I'll review it every few days.
Oh, good, good, very good. Yeah, I still couldn't find a way to do that. Yeah, I have my wife take care of some of those, but not anything. But she's great. She do on the kind of like loan whatever for me. Yeah,
Yeah,
yeah.
yeah,
So yeah, that's the time we not doing anything because it's too much work to do the loan, and I'm tired. I work like full time. I have no time for that. So I
yeah.
do several, and then okay, I I'm done. And then we stop for a while. We don't do anything for a while, and then see start, and it's good. Take care of on everything.
That's great.
Yeah.
Let's take a look here. All right. So what I did here again,
Okay.
I'm gonna go through this with you, but if we're looking at kind of putting that dollar amount in there, I'm gonna come up with a better plan for you than just one policy on you. I'm
Okay.
gonna
Yes.
I'm gonna split it up and I'm gonna do different companies.
Okay.
Um, but just to give you something to look at,
Yeah.
um, here's what we did. I've still got your preferred plus, and that's the rating that you were approved for, so you're gonna get that one.
Okay.
And then what I did is on the 500, uh, the illustration that we looked at just a minute ago was about a 70-30, and then if that extra PUA, the policy ends up being about a 75-25 split was the one
Hmm.
that we were going to put in place.
Yeah.
So that's the same thing that I did here is I just took 500 and I multiplied it by 0.25. And so that gets us to 125,000 going towards the base premium.
Hmm.
The difference between the 500 and the 125, that's what's going to the PUA. So I've got 375 here.
Okay.
Okay. So same thing, right? Is this is showing it to be max funded. So it gave us the same notification that if we're able to max fund this, we're going to run into some mech issues in year 23. So we've got
Yeah.
20 plus years that
Okay.
we could do this. So let's take a look.
Yeah.
Let's look at this one first. So we've got 94. Here's our base and FPR. We've got 94 and 30. That gets us to that 125. That's going to be the base that's going to be put to the base in the FPR. And then it
Okay.
shows 375 here for a total of 500.
Yeah.
Again, the 375, this is where all the flexibility, right? If we were to put a policy like this in place, the 375, that's all optional,
Okay.
right?
So the
It,
94 is the must, right?
we're gonna include the 94 and the 30 together.
Okay.
So the part that we call the have to,
Mm-hmm.
right? Hey, we have to pay this every single year to keep the policy open. It's
Okay.
going to be the base and the FPR. So in this example, would be the 125.
Okay.
Yep. The
And
125, John, I'm going to
yeah.
be really honest with you, right?
Mm-hmm.
That's a have to. That's a pretty big have to.
Yes. So
What
we
are
had
your
to make
thoughts on
sure.
that?
You had to make
Yeah,
sure
what
that
are
we
your
have that every year, right?
Yeah,
Okay.
yeah. So from my side, right, is my concern would be kind of putting a have to in place of that amount, right? We need to be really, really confident
Yeah.
that we will be able to hit that number.
Yeah. I got you. We don't want to stress that much.
Exactly, right? Same
Yeah.
reason we don't go buy a big house, right? Is we don't
Yeah.
want a lot of stress. We got to
Yes.
keep this
I.
thing simple.
Yes.
Uh, this right here, the 375, that's optional, right? Hey, if we have 375, great. We can max fund it. If we have 300, we can put in 300, or we could take it all the way down to zero if we want to.
Okay. So let's say if I put just the minimum, so the cash value is based on the based on one number.
The cash value in the first couple of years is going to be driven by your PUAs.
Okay.
Okay. The base premium, and I can run this, we can maybe pay the first 2 years
Mm-hmm.
of PUAs, and then I can turn it to zero
Yes. Yeah.
and
Yeah.
see what that looks like. Yeah.
Yeah.
We'll start kind of worst case scenario and say, hey, what if we
Yes.
just pay for 2 years? What does that look like?
Okay. So 2 years. Okay.
Wow, this isn't bad. All right, so let's look at this. So 500 goes in year one. Do you remember the split between base and PUA? What was that amount, John?
94 and 30.
Great. And if we add those two numbers together, what does that add up to?
125. 124.
Perfect.
Yeah.
Perfect. So 125 is the have to. It's the same have to on the last example, same one as
Yep.
this one.
Okay.
And then what's the PUA amount in year one? You remember?
375 something.
Perfect. Perfect.
Yeah.
So that's how we get to this 500. So year one, 500 goes in, and we've got 379 that's going to show up as cash value.
Okay.
Okay. So what was the PUAs? Do you remember?
I'm sorry. What was the PUA?
What was the PUA amount that was paid in year one?
Oh, 275.
Yep. And how much cash value is showing up here in the policy?
379.
Three, right? Really close. Give or minus a few thousand. So again, right? The
Yeah.
PUAs are what's going to be driving the cash value early on.
Okay. So
Year
basically, just
two,
a yeah.
yeah, year two, we've got 500 that goes in, and out of
Yeah.
that 500, how much shows up as cash value?
Okay. 418.
Yeah.
Getting closer.
Year three, we don't pay any PUAs, right? We just pay the base premium of 125.
Yep.
How much shows up as cash value?
Okay. 122. Close.
Really close. That's not bad, right?
Yeah.
Year four, 125 goes in. How much shows up as cash value?
All right. 161.
161. Now
All
we're
right.
positive almost 37,000. And then every year that is going to increase.
Okay. Yeah. So that's so we kind of pretty flexible.
Yep,
So what I have to do to get that 100 into like 125 something every year.
exactly.
Yeah.
Yep.
Yeah. I got you. Yeah. So after I sell the business, so my income will cut to the half. So yeah. So this gives us some flexibility, but I think it would be safe when we spread out to different companies anyway. So we just
Hmm.
saw one and then another one, and when it get to yeah, like the total about 250 something, we pause right there and see how everything go, and then we can
Yeah.
yeah, we can keep going. Yeah, I
Okay.
probably sell the business next year.
Are you really?
Yeah, yeah,
Well,
yeah.
that'll be good, man. That what a great what a blessing, right?
Yeah, yeah, that's right. And I can spend a little more time with the investment. So the only thing that I keep me not really thinking, but like, yeah. So right now I have like multiple streaming income. So to
Yep.
save, when I sell a business, anything will be on real estate.
Hmm.
And if the market doesn't do well, and then that will be, yeah, that's a little concern on that. Yeah,
Absolutely. And the best solution
yeah,
for that, right, is to have our expenses be really low.
exactly right.
Right?
Yes,
Yeah.
yes,
If
exactly
we
right.
if we yeah, we've got a high expenses every single month, man, we can run through some money pretty quickly,
Yes,
and that's a huge burden. So,
yes, yes,
uh,
yeah,
yeah, awesome. All right. Well, looking at this one, right? If I
yep,
were to look at this as kind of the first go around and just the first design, granted, I'd do some stuff differently here.
yes.
Uh, I've got my opinion, but I'll ask you first. What are your thoughts on this one?
Okay, so yeah, this one is good. So probably I mentioned earlier, I will start with like a few, just like what we have, until we
Yeah,
reach the maximum of 200 250 total a year, and then we stop right there, and then see how it
awesome.
go in the next couple of years. Then we just slow bump it up.
Perfect. Okay.
Yeah, yeah,
So here's a suggestion. What if we took this 500 and we just kind of planned and said, hey, what if we put in, I'm going to make up a number. So I'm
yeah,
just
yeah,
putting
yeah,
an idea out there.
yeah,
What if over the next 5 years we planned on putting 100 in a year, right?
yeah,
So this year, hey, let's try to get to 100. Next year, we'll add another 100 and we'll see how that is. And then the
yeah, yeah,
third year,
yeah,
yep.
yeah, yeah. That's good plan. Yes.
Okay.
Yeah,
So let's do this. What if I back off of this
yeah.
and let's make this
Oh, someone may want me to die for 13 million.
maybe, but it won't be me.
Yeah.
Let's do this. Let's take.
The trust will get the benefit.
It will, yeah.
Yeah, and my two son is the one who will take care of the trust, but they don't know anything yet.
That's right.
Yeah. So do you put almost on your money you make into the policy? Like let's say whenever you have some saving at the end of the year, so the policy will be the first place to go.
I do.
Oh, you do.
So what I do is I have most of my actually I have 2 months of expenses in
Yeah.
my checking savings.
Okay.
And then anytime I get over that,
Yeah.
is I just sweep it and I pay a premium or I pay my PUAs on different policies.
Yeah. And then if
Yep.
it's already maxed out, then you create another policy.
You got it. Yep. So
Yeah.
my first couple policies, they were pretty small, right? As I was kind of dipping my toe in, making sure that the policies were going to work the way they were going to work. And then as my income had grown and I've gotten more comfortable with the strategy is, yep, the premium amounts have gotten higher and higher. So I've
Yeah.
got plenty of places to put kind of PUAs in cash.
Oh, okay. So
So
yeah. So like in kind of like downturn something, how to do to protect from downturn? Like whenever you get like less income and then it's don't have enough money to pay on the policy altogether. How do you deal with
so
that?
great question. So like on the example that we just looked at, let's do
Yeah.
this. I'm gonna keep the same design. Two. I just have this PUAs being paid for the first 2 years.
Okay.
Same design that we just looked at. I'm just kind of cutting it in a fifth.
Okay.
And so same thing. So what you were asking
Yep.
is let's say I do have a down year,
Yep.
right? Let's say the next I had 3, 4 years of good years
Yep.
where I was able to kind of put money in that I wanted to. And then let's say in year four,
Yeah.
I had a down year where I've just got to be able to put in the base premium.
Yep.
one, the way that I've set mine up is exactly like this. It's an amount that I know that, man, I can fall out of bed and make that premium amount,
Yes.
right? And so here in year four, if everything goes sideways and I pay 25,000,
Yep.
I can turn around and I can take out 32,000.
Okay. I got you.
So not only am I in a better position financially
Yes.
because had 25, I paid 30, and now I've got 32,
Yep.
is again, the concern and the burden that I have for creating cash has taken off of me.
Yes.
And guess what happens if we just have that same situation a little bit later down the road?
Yeah.
Let's say it happens in year nine. Year nine, everything goes sideways, but I still need to pay my base premium. I pay 25, and now I can take out almost 50,
Okay. Yeah. Pretty
right?
much you put money there, you get it out right away with more.
Exactly. So if I'm on tough times here in year nine, I'm hoping and praying to get to my policy premiums, right? Man, I
Yeah.
want to give them 25 and I want them to give me back 50.
Yeah. How about this? Worst
Yeah.
case scenario. We don't have that 25. We borrow from that and put it right back.
Perfect. That's exactly. That is every time I cover this, that option, I always tell clients it's a great short-term option,
Yes.
right? So it's a band-aid. It's not a permanent fix.
Because the difference on the interest rate, right?
Yeah, yeah. But even if we get in that situation, right? Maybe we've got some loans on this policy in year eight. So maybe we don't have 376, but my recommendation for clients, our recommendation is always to leave at a minimum 1 year's base premium in our policy. So that way we can buy time, right? So if I've got 376 in here, the
Yep.
max that I would recommend taking out is about 350.
Okay, leave 25 left. Just in case we don't have money, and then we can borrow 25 and put right back.
Yep, exactly. And then we're
Okay.
still positive 8 grand.
Okay.
Actually, I'm sorry, more than 8 grand. Here, it's 25 and 43. So we're
Yeah.
positive 18
18.
grand,
Yes.
right? So we just had 18 show up on our doorstep when we needed it.
Okay, got you.
Yeah.
Yep.
So
Hopefully, I don't have to do that.
yeah. So we've talked about a couple of things here, John, and I want to make sure I'm tracking with you.
Yeah.
We just put a policy in place. We kind of increased the premiums to about 36 on the
Yep.
one that we're going to kind of reset.
Yep.
Is that a pretty comfortable, easy number for you?
Yeah.
Okay. And then we talked about 500, but the plan that I'm hearing that we want to implement is maybe we start with 100, and
Yes.
then each year we analyze and see if we can add another 100, and we look at doing that for the next 5 years. Does that sound right?
Yes.
Okay. So this illustration that we're looking at, do you want to put an application in addition to the one that we just put in place?
Yes.
Okay, all right. So what I'm gonna do here is I'm gonna get on the phone with Becky and I'm gonna have her reset the first one,
Yep.
and then I'm gonna start an application for this one right here. So you're gonna have two applications that are gonna come over to you here pretty
Yeah.
quickly.
Okay.
And what I'm gonna do is the same thing that I did that we covered at the beginning of the call
Mm-hmm.
is on this one, I'm gonna change kind of our ratio. So maybe I'll put, I don't know, maybe 30 or 35,000 to the base premium.
Mm-hmm.
And the reason I'm doing that is to kick the underwriting amount up so we can get an approval just above what we actually want
And
to
then
do.
we change it back to maximize the cash value
Yep, you got it.
max. Okay.
Yep,
Yes.
you got it. Yep,
All right. So we
perfect.
don't have.
So,
So the point is, I don't really concern about the base premium is so high when I first sign it, right? That's just something to keep the whatever the debt and benefit.
perfect. Yep, that's
Okay.
exactly right. Kick
Yep.
that up during underwriting, we get the approval, and then we can kind of submit what we want.
Okay. All right.
Perfect. Any questions on what we covered here?
No, I'm good.
Okay. All right.
Yes.
Um, I'll get that going. I'm in the office on Monday. If you get in there and you look at some of these applications over the weekend, you have questions.
Yeah.
Uh, but I'm out Tuesday, Wednesday for Christmas, and then I'll be back in Thursday. So
Okay.
If it's urgent, let me know. If not, then
All
I'll be available Monday or Thursday.
right.
Okay.
Thank you, Cameron. All right.
All right,
And
John.
Merry Christmas.
You too, man. We'll talk soon.
Thank you. Bye.
Bye bye.